If you're not borrowing the money, I mean, a 5-year payback is still a 20% cash on cash return. It really depends. I think if you have tax appetite, depending upon how you're financing it, solar for storage is interesting because if you look at your pro forma, your major operating expenses are staff and energy.
This is the Self-Storage Podcast, where we share the knowledge and skills from the industry's leading investors, developers, and operators to help you launch and grow your self-storage business. I'm your host, Scott Meyers, and over the past 16 years, we have acquired, developed, converted, and syndicated over 2 million square feet of self-storage nationwide with the help of my incredible team at selfstorageinvesting.com, who has helped thousands of people achieve greatness in self-storage.
Listen, there has never been a better time to invest in self-storage, and there's no better team than ours to show you how to do it because we wrote the book on how to invest in self-storage. Literally, we created the best-selling home study system titled How to Find, Evaluate, Purchase, and Manage Self-Storage Facilities. We have helped thousands of people launch and scale their self-storage business, go-to resource for all things self-storage. That's because we not only talk the talk, we walk the walk, day in and day out since 2005 through now. 2 recessions and amassing a 2.5 million square feet of self-storage, totaling over 15,000 doors nationwide. There is nobody else that has more experience in self-storage that is teaching people how to invest in self-storage. So if you're ready to launch and scale your self-storage business, then go to selfstorageinvesting.com. Click on the events tab to grab your ticket to the upcoming Self-Storage Academy. So that again is selfstorageinvesting.com. Click on the events tab. Seating is limited. And on behalf of our team, we look forward to seeing you then. Take care.
Jason, so good to see you. Welcome to the show.
Scott, thanks for having me.
My pleasure. My pleasure. I've been looking forward to this as we're embarking down a different path right now with, different programs and different structures and also taking a deeper dive into conversions. I've really been looking forward to having our conversation today. So for Storage Nation, I've given them a little bit of background on yourself and your bio, and the rest of the information on you and your company is in the show notes. But if you would, in your own words, maybe fill in the gaps and tell us a little bit about your story and a little bit about what you're doing right now.
Yeah, so I'll rewind to the first job. I did acquisition development financing for 5 years out of college, learned a lot, did some private real estate for 5 years, but always had the entrepreneurial itch. So in 2010, I looked at a bunch of different business models and ultimately started an energy company with 2 business partners. So we have 3 concerted focuses. So 2010 was a cocktail napkin, worked white nights and weekends. By 2012, company was sustainable with 3 concerted focuses. We have a commercial solutions division, a utility solutions division, and a financing solutions division. We'll probably spend most of our time today with the financing solutions side, but I can give a snippet on the other 2. Commercial solutions, we broker electricity and natural gas and do energy efficiency and solar projects, mostly for the commercial real estate community. So reducing operating expenses through energy to improve net operating income. Solar is great for self-storage. If we have time today, we could always unpack that. Second division, utility solutions, where we staff engineers and business development professionals to the utility rebate programs around the country. So we have engineers and business development professionals in New Orleans, Georgia, South Carolina, DC, Maryland, New York, and New Jersey. That's been a nice growth opportunity for our business. And then our financing solutions team finances energy efficiency projects and does C-PACE financing as well.
Well, indeed, that is what we wanted to focus on, as I mentioned, selfishly, but also for the rest of the folks in Storage Nation here that are looking to do conversion projects or even ground up development. The C-PACE program is a fantastic program. It's got a lot of benefits to it. It doesn't work in every scenario, as we found, as much as we'd like to think, but certainly in the capital stack, it has its place for projects that make sense. So let's dive into that a little bit and talk about financing those energy projects, how that fits in with C-PACE as we're looking to do either conversions or development.
Yeah, I'll start with kind of a primer on C-PACE, and then maybe we could move into case study format. I'm not a big acronym person, but C-PACE stands for Commercial Property Assessed Clean Energy. So if you think about your development budgets, anything that uses a unit of energy or a unit of water can be financed through the program. And that's roof, lighting, HVAC, building envelope, elevators, windows, plumbing. There's a bunch of things that we can finance through the program. But we usually look at it from the percentage of the capital stack. So for your listeners, you should think like 20 to 30% of the capital stack would be eligible to be financed through CPACE related improvements. And if we look at it, the acronym again, commercial property assessed clean energy. So this isn't a deed of trust on the property itself. It would be a special assessment on the property taxes, which would ultimately be the collateral in this lending situation. So a little different. And requires, some education. But the way I would look at it is there's really three hurdles to unlocking CPACE financing. The first is a financial sizing exercise. So we're going to want to make sure that there's adequate debt service coverage at stabilization to service the senior lender and to service the CPACE lender. Self-storage is a great asset class for that, a little slow to stabilize. But once these assets stabilize, they're typically cost constrained deals, not debt constrained deals from the lending environment. So there is that adequate cash flow or additional cash flow to service additional debt on the project. So hurdle number one is financial sizing. Hurdle number two is technical review. Oftentimes PACE is in 30 states around the country. Oftentimes it's prescriptive. So if we can show an improvement above and beyond base building code or existing conditions for your conversions, for our energy related measures, we qualify as part of the program. So if you have a SEER requirement for your conditioned self-storage space of 13 and you do a SEER 13.5, 100% of your HVAC line item in your construction budget would qualify for the program. So that's the second hurdle, is the technical review. And the third hurdle is lender consent. We briefly discussed it, but the CPACE sits as a special assessment at the property tax level. It's a non-accelerating lien. It can't be accelerated at any time, but we are part of the property taxes. So we need the senior lender to get comfortable with the structure. And if we can clear those three hurdles, financial underwrite, technical review, and lender consent, you can unlock the CPACE financing. And folks might ask, like, why would I do this? If my typical structure is debt and mezz or debt and pref, some sponsor equity, this is financial arbitrage, right? So the CPACE is fixed rate, it's long-term, it's non-recourse, and it's non-dilutive financing. So that's really the why. The PACE is trading, 10-year plus 400 right now. It'll be fixed 2 weeks prior to closing. So, you're looking the mid to high sevens for fixed rate, long-term, non-recourse, non-dilutive financing with terms as far as 25 to 30 years for this type of financing. So we're reducing operating expenses by putting, more efficient energy equipment into your self-storage facilities. And we're reducing your weighted average cost of capital by leveraging the CPACE and replacing it with some more expensive mezz or pref. Last thing I want to mention, before we transition, is the CPACE is also oftentimes taking the place of participants in the capital stack. So a lot of the local banks are tightening up right now. The CPACE source of funding is insurance companies and REITs. They have an insatiable appetite for this paper. So the CPACE is there. We can access it. And folks are oftentimes upsizing the CPACE as part of their capital stack if they're getting cut from a loan to cost standpoint from their traditional senior lender to provide closing certainty in their transactions.
Well, there's certainly a lot to unpack there, Jason. A lot of other questions that I'll ask on behalf of our listeners. So one of these is, I think it's kind of obvious, goes without being stated, but when do you come into the planning stages of development or conversion? I think the answer is, immediately or ASAP as you're beginning out that. But, what else would you add to that?
Yeah, I think it's a good question. I should mention kind of the really strong applications for CPACE: ground up construction, reposition or value add energy related capital projects. If you're acquiring an in-place self-storage deal, you don't need any energy related improvements for those. We're not going to be accretive to those transactions. But if you have the ground up, if you have the reposition, if you have the energy related capital projects, we can definitely help out. And to your point, Scott, I mean, we do ground up deals, and we're working lockstep with the design team throughout the entire process. So we're happy to enter there. We can actually even do retroactive transactions. So deals that have received certificate of occupancy within 36 months and put efficient energy related improvements into their projects, we can retroactively finance those. So in short, I think the earlier the better, but we can come in at any life cycle in the process. We've been part of the design team for ground up construction deals, and we've been brought in 8 weeks prior to closing and have been able to qualify enough energy related expenses based on how the building was currently designed.
Well, so that there's another application that I would guess that there's some projects right now that have been in lease up or getting ready to come into certificate of occupancy and coming online, that maybe the runway isn't there, or their cost of capital for those interest reserves, the lease up reserves now maybe a little bit higher. That I would bet that this would be a prescription for that. And perhaps you found some folks reaching out to you, or you may be reaching out to them. Any increased activity in being able to provide that, I guess, additional bridge financing, especially at 7% fixed.
Yeah, that's right. I mean, think about if you rewind. We always like to replicate playbooks that have been successful, right? So if you look at, just assume you brought a hotel online in March of 2020. We all know what happened, right? Like your income stream evaporated overnight. We did a lot of retroactive financing for hotels in March of 2020. The capital was used for principal curtailments as they were tripping covenants. It was replenishing operating reserves and capitalized interest. And we would do it for 2 to 3 years. And if you fast forward to May of 2023, good luck booking a hotel right now. I mean, that market is back. I think that playbook is, and we have started doing some retroactive financing. I think that playbook will be utilized again, as you articulated, for slow lease up, for cost overruns, for interest reserve depletion. These are all good use cases for CPACE. And again, it's the 3 hurdles, right? We have to show, sizing at stabilization. We have to get through the technical review, which is super simple for a building that's already been delivered. We just got to review the plans and qualify the expenses. And we need the senior lender to be on board and provide that lender consent. But yeah, I foresee that kind of that hotel playbook being replicated in 2023 for projects that are a little slow to lease up, have cost overruns or interest reserve depletion.
Jason, what we know the banks that'll utilize CPACE, and we usually, we start that process going to a CPACE program and then asking what lenders they work with. But what percentage would you say of lenders out there, either or, are interested and that you are aware of that will, allow and participate with the CPACE program versus don't? Do you have a sense for that across the country?
Yeah, so we have a list of over 400 lenders that have participated in the program and are willing to offer lender consent. I think the lenders really fall into a couple of different buckets. We've had a very, very high success rate with regional and super regional lenders, where you can sit down and have an educated conversation with someone on the relationship side and someone on credit. We have a very high batting average there. I think it starts to fall off if people are leveraging agency financing, CMBS, or if they're working with one of the money center banks. Sometimes that's a little bit more difficult. But from the deals that we've worked on, typically self-storage or, sub $20 million cap stacks, good opportunities for regional and super regional banks. And they, when you can have an educated conversation and get them comfortable, very high sell-through rate of the regional and super regionals providing lender consent.
And I think that's always a key, and not to discredit our lending sources. But when you said an educated conversation, there are some folks that even though they're educated, they just want to entertain that conversation to say, we are the only ones within the capital stack that are going to have lien or, status or a right to this, and we won't allow anybody else. But if they recognize that, hey, it's going to take a little more to get this thing to the finish line, and actually spreading the risk makes a little bit more sense. That isn't always the case, but when you do have an audience and can have those conversations, it makes sense more. The more you dilute the capital stack amongst more sources, to me, it seems like a safer deal.
And there's a lot of ways from a structural standpoint to mitigate the perceived senior lender risk. Again, if we kind of talk case study, $10 million deal, $6 million from the senior lender, we do $2 million, the sponsor does $2 million. at a 7% rate. It's interest only. It's $140,000 payment annually, right? So we'll lend capitalized interest for the first however long it takes to stabilize. Construction period through stabilization will increase our loan to not only cover the $2 million, but to capitalize the interest reserve and closing costs to get you to stabilization. And from an underwriting standpoint, the only thing that the senior lender needs to worry about is 1 year's taxes. And some of them escrow, right? So we have capitalized interest. They can escrow if they need to from a comfort level to get above and beyond that. And if for whatever reason the deal went south, that $2 million that we lent in this case study, it can't prime their mortgage. The only thing that can prime the mortgage is the annual debt service on the CPACE, or that $140,000 in our example. So if there's a will, there's a way. If it's a sponsor that has a relationship, a deal that makes sense, it's a very high probability of us executing. If it's the first deal that someone's done with a bank and the debt service coverage is 115 and we're trying to put additional debt into the project, like that's probably going to be an uphill battle.
Well, let me ask one more question, and then I'll let you get to that case study, because I know that everybody's hanging on and waiting on for that as well, Jason. And that is, we've looked at projects, solar, for instance, adding solar to a particular development or a conversion. And what we've seen is that typically, I know the technology is getting better, but typically we've got a 5-year ROI on that. Well, before it begins to either break even, and then either we're taking care of all of our needs and our electricity needs, and maybe even selling some back to the grid. But many of our projects, we're selling in 5 years. They're in our fund, and we're exiting those funds and all the assets in it within 5 years. And so, and many times it doesn't make sense to do so. I mean, we could maybe exit or sell on the projections going forward of what that looks like. But in essence, if we're spending more money to get across the finish line and we're borrowing money from, say, a CPACE program and even private equity, the drag on the cash flow to pay for those additional funds of adding, say, solar or some of these other, energy efficient projects sometimes doesn't balance out. So I try to make that a simple question, but, tell me, is there an instance in which, does it make sense? And do you look at, does this only make sense to put all these measures in place to be extremely energy efficient and finance them through a PACE program if you're holding long term, or does it still work for those of us that may be selling in say 5 years or less, or somewhere around that time frame?
Yeah, so I think it's two buckets. I think I'm going to parking lot your question for a moment, just to make sure that we really make the PACE value proposition crystal clear. As part of the deal we talked about before, $10 million capital stack, and we're doing $2 to $3 million of that capital stack, we're financing things that you would already be putting into the project anyway, right? You need a building envelope. Depending upon the project, you might need an elevator. You're going to need lighting. If it's conditioned, you're going to need an HVAC. So in that particular example, all we're doing is reducing your weighted average cost of capital for measures that you're already going to be putting into the project. So I just want to make sure that we highlight that. Solar, battery storage, all of that stuff is also eligible to be financed through CPACE. I think that's going to be more on a deal by deal basis, right? So if you look at solar, there's really 5 financial attributes to a solar project. 3 are the same no matter where you are, and 2 are location specific. So the 3 that are the same wherever you are the federal tax credit, the 30% investment tax credit. So if you have federal tax appetite, you're going to be able to monetize that. And what does that mean? If you have a $100,000 system, you finance or write a check for $100,000. When you file your federal taxes, you're getting a $30,000 federal tax credit in that particular project. So we've just written the cost of the system down to $70,000 and mitigated our tax consequence. So there's 2 depreciation schedules, accelerated and normal, and at the maker's level. So again, if we build a project in Hawaii or New Jersey, that's going to be the same thing. The 2 things that are going to change at the localized level is the solar renewable energy certificate. Every 1,000 kilowatt hours of power you produce, you receive a certificate that can be monetized in the market. Now in Maryland, that certificate might be worth $35. In DC, that certificate might be worth $450, right? So that's going to be highly localized. And then the cost of electricity, right? The cost of electricity in Massachusetts is much different than the cost of electricity in Florida. So I think all of that, it goes into the pie, and where you determine value proposition. if you're not borrowing the money, I mean, a 5-year payback is still a 20% cash on cash return, right? So I think it really depends. I think if you have tax appetite, depending upon how you're financing it, solar for storage is interesting because if you look at your pro forma, your major operating expenses are staff and energy, right? So if you can optimize your staffing and reduce your energy costs, you should have a nice net operating income.
Yep. Understood. All right. So let's talk about a conversion opportunity that you were involved in and do this mini case study.
Yeah. So we were talking before we started a little bit. It feels like people are self-storaging everything. If that's a word, we have a Toys R Us that was converted into a self-storage around us, which I thought was super interesting. And we actually were part of the capital stack for an old printing facility. Obviously structurally sound, has the live loads, made all the sense in the world to reposition this large printing facility into self-storage. So obviously more energy related expenses to finance as part of a ground up deal, envelope and such than there would be as part of a conversion. But we were still able to get this deal 20% of the capital stack. We financed, they actually did wind up doing a solar array on the roof. We did a solar array. We did an elevator modernization, all the associated costs of that. We did lighting, HVAC, and they put in there was a toilet or two in the whole place, but they put in low flow toilets and sinks, and we could count the entire plumbing line item of the entire project but for the plumbing, you couldn't achieve water savings. So we got them 20% of the capital stack. There was plenty of debt service coverage at stabilization in order to service the debt on the senior and us. And we dramatically reduced their equity requirement. And that's where that financial arbitrage comes in. Fixed rate, long-term, non-recourse, non-dilutive financing. And this was a function of the market, right? Like the 10-year treasury was in a much different position, as were all of the treasuries 12 months ago. The intent was to refi the C-PACE out as part of the recapitalization of the project. Well, the PACE is fixed. And at that time, the PACE was probably fixed at 5.5%. And they're going to keep it in for 20 years. 20 years was the maximum in the program that we did. And they're going to have the benefit of 20 years at 5.5% money if that's what they want, and maintain that optionality. So it was a great project. With some of the excess space, they did a car corral. So there's some vintage cars, there's some RV parking out of the back, and they've leased up ahead of pro forma. They did a wonderful job on the project.
Well, we are self-storagizing, I think is your term, or self-storaging, anything and everything. What we like is, we like cheap square footage, going into a project. The beauty of conversions is that many times the apartment folks, the condo folks, any retail, if it was retail, by the time everybody's taken a look at it and determined it isn't going to work for those uses, and it's lingered on the market, that the price goes down, and then all of a sudden the seller and zoning, the city, everybody then becomes amenable to self-storage. And then that's when we come in and purchase it. We say pennies on the dollar, but certainly for less than what we would build from the ground up in terms of, the shell per square foot, and then adding the doors and walls. And depending upon what part of the country, we can buy it in November and still do construction, and be ready for spring lease up, because we're not having to deal with the weather and pouring concrete or, doing really anything else at that standpoint. So there's just many reasons. And infill locations, if the zoning is already in place where they have a moratorium, just conversions and finding those projects are very, there's just a lot of advantages, quicker time to getting opened, and anything and everything else that goes into the conversion side. So this is just one more piece that adds to that as well. So one of the questions before we get to the other two buckets, Jason, and that is, you're able to, you had mentioned 20%, up to 20% of the capital stack. And that depends upon, where the senior lender comes in. If they're at, I think we're gone are the days of 80%, or at least for now, they've been tabled. So usually a lender, even if they are at 80% LTV, they're not going to allow you to come in at 20, and then the sponsor, the syndicator, the buyer, developer is not going to be able to come in for no money down. But what does that look like in terms of, then backing off on the capital stack and ratios? Right now for our development and conversion projects, we're at 65%. Some are more comfortable with 60. So you're coming in and bridging that gap up to 85. But are the things that we just need to be more mindful of as we're kind of developing this in terms of the equity that we have coming in? Because, as I see it, one more point, our private equity that's coming on top, if our lenders are coming down with a lower LTV, that means that we need to bring in more capital. And that capital for us is expensive. It's not our cash, it's our private equity. And if we're trying to get them a mid-teens to high teens, 18, 19, 20% IRR over 5 years, that's more expensive than a 7% fixed is coming in with PACE or somewhere thereabouts. So, tell me how you're structuring those and what are you seeing in the marketplace in terms of manipulating the percentages if people are doing that?
Yeah, no, great question. I think it really comes down to debt service coverage, right? So I think we're going to be accretive for the cost constrained deals, not the debt constrained deals. I think the lenders are still going to want to make sure sponsors have skin in the game and likely going to leverage the HVCRE requirement, that came down after the last financial crisis to make sure that there's enough imputed cash or imputed land value in the project to satisfy that requirement. But if we can, show debt service coverage at stabilization and enough energy related measures to finance, we'll plug that gap in the capital stack between what the lender's willing to lend, the HVCRE requirement. We can kind of slide in accordingly. The upper limits of the program are 30% of the stabilized value of the property. We usually use a number of 20% of the capital stack for self-storage because it's a pretty safe number. We feel comfortable we can find enough eligible related energy expenses in the project to satisfy that requirement. So it's, how do we have debt service coverage? How do we have enough energy related expenses? And how do we get that lender comfortable ultimately? So to succinctly answer your question, I think we would follow the underwriting of the senior lender. What is the debt service coverage that they're requiring? What can we show at stabilization? And are they cost constraining you versus debt constraining you on their leverage? And how do we come in and maximize the CPACE and still achieve the lender consent ultimately at the end of the day by satisfying the debt service coverage requirements?
Mm-hmm. Certainly makes sense. It's all for the lenders. It's all about the service coverage ratio, especially these days. All right. So we've talked about one of the three arrows in your quiver with regards to the financing. Which one do you want to pick next?
In terms of the financial solutions and commercial solutions, I think for your audience, we could probably touch on both of them. We could clear the deck with utility solutions pretty quickly. If you have a utility rebate program in your market, you should be taking advantage of it. It's, it's free money for your project.
Are there any markets that don't have those grants and other programs available?
Yeah, so there's different pockets, right? There's kind of federal pockets, there's state pockets, and then there's utility themselves. So we're one of my other business partners runs that business line for us, but in the markets that we operate, they're ratepayer funded programs. So if you actually look at your utility bill, there'll be a small charge. In Maryland, for instance, it's called Empower Maryland. If you pull out your utility bill, you see an Empower Maryland charge. It's a small charge assessed to everybody across the grid that goes into, what we would call a utility rebate bank. And that money is for eligible projects, right? So if you bump up your HVAC or you bump up your lighting, whatever the case may be, you're eligible for those rebates. Some of them are prescriptive. So I think that's found money for your projects. I would encourage your listeners to make sure that they're looking at the federal programs, the state programs, and the utility programs to see if there's some untapped potential there. Hopefully their MEPs are familiar with the program and can help them walk through. But most of the rebate programs have administrators that help promote the programs and educate folks. So I think on the utility solution side, as it relates to the listeners, just make sure you're taking advantage of those programs because they're out there. On the commercial solution side, again, there's 13 deregulated markets around the country where you can competitively buy your energy. People typically competitively buy their energy for two reasons: savings and budget certainty. So we can, reduce the cost that you're paying per kilowatt hour by competitively bidding out your energy. And we can also lock you into a long-term hedge if that's of interest to lock in those operating expenses. If you just get your power from the utility, you're going to change monthly, quarterly, or semi-annually, depending upon your rate tariff. versus if you can fix it in for 5 years, you know what your costs are. So there's 13 markets around the country where you can competitively buy your power. We're active in all of those in our commercial solutions division. And then as we mentioned before, there's some energy efficiency opportunities and some renewable opportunities to reduce operating expenses depending upon your investment thesis. And if I'm looking at a pro forma, you really have staff and energy costs are your major operating expenses from a self-storage facility. So let's try to optimize each of those as best as we can.
Yeah. And if you can figure out a way to allow us to lower our property taxes, we'd appreciate that as well, Jason.
Sure.
Those are the top three. All right, my friend, what's next? What's left?
No, I think we tackled it. I mean, I would encourage folks that are looking at ground up construction or reposition to, consider the CPACE program. It's going to reduce their weighted average cost of capital in a very, very meaningful way. And I think importantly, we're lending, right? It's national and in 30 states. So if your local lenders are, cutting you back a little bit, and to your point earlier, Scott, if they're 50, 60 and, you don't want to plug in the hole with, 40, 50, 60% equity, CPACE is a really good option to plug that hole in the capital stack.
100%. Jason, thanks so much. Appreciate this. Long time coming, and wanted to fill in the gaps, both for myself as well as for Storage Nation. So what are the best ways to get in touch with you? And in the meantime, this was maybe 201 level for some of these folks. So where are some other resources where they can dig in and dive in, perhaps on your website, to finding out white papers or other resources to bone up on the CPACE program, and then also what qualifies and a deeper dive into what we talked about?
Sure. Our website is MD, like Mary David, Energy Advisors, ADVISORS.com. Have chock full of content there. I can be reached at jason@mdenergyadvisors.com. And if it would be helpful, I can shoot you a 3-pager that you could put in a link in the show notes that provide that primer overview of CPACE, and here to answer any questions that the listeners may have.
That will be perfect. We'll put all that information in the show notes, as well as that PDF for everyone here to learn a little bit more about Jason. Thanks so much for your time today. Appreciate it. And looking forward to having you back.
Yeah, thank you.
All right. Take care. Hey gang, wait, 3 things before you leave. First, don't forget to subscribe to the Self Storage Podcast and turn on your notifications so you never miss another episode. And while you're there, please leave us a 5-star review if you like the show. Second, be sure to share your favorite episodes and more via Instagram, and don't forget to tag us. And lastly, head to the links in the show description and hit the follow and subscribe button on Twitter and Facebook to get a front row seat as we grow and scale our business and bring you along with us. Take care.